Hey everyone, and welcome to The Explainer. Today, we're diving into a technology that's building a massive bridge between trillions of dollars in physical stuff and the digital world of blockchain. It's called RWA Tokenization. Seriously, what if you could trade a tiny piece of a skyscraper just like you trade a stock? It sounds like something out of a movie, but it's happening right now, and we're going to show you exactly how it all works.
So what's all the buzz about? Well, think about it. Most of the world's wealth is locked up in things that are super hard to trade or split up. Like giant office buildings, priceless art, or shares in a private company. These things are basically stuck. They're illiquid. And RWA tokenization, well, it's designed to change all of that.
Let's just make this real for a second. Imagine buying a small, easily tradable slice of a landmark building, or maybe a tiny piece of a famous painting. This isn't just a fantasy. It's the core promise of tokenization, to crack open the world's most valuable assets and make them accessible to, well, pretty much everyone.
And trust me, this is not just some small niche idea. The market for tokenized real-world assets has already exploded to over $12 billion. That's not just a little bit of momentum. That's a huge statement.
The real signal here isn't just the dollar amount. It's who is getting into the game. We're talking about the absolute giants of traditional finance. When institutions like BlackRock and VanEck start tokenizing assets, a fundamental shift is happening.
Okay, so we know the market is huge and the players are dead serious. But what in the world is an RWA token? It really just breaks down into two simple core ideas.
First off, you've got the real-world asset, or RWA. And this is exactly what it sounds like. It's anything of value in the physical world or the traditional financial system. We're talking real estate, gold, government bonds, even a stake in a private company.
And then you have the tech that makes it all possible. Tokenization. This is just the process of creating a unique digital token on a blockchain that represents your ownership of that real thing. It's kind of like a digital deed or a digital title, but it's one you can trade instantly, 24/7 with anyone in the world.
So it's a simple formula, right? You combine the real asset with a blockchain token, and boom, you get an RWA token. It becomes this digital twin that carries the exact same value and the same ownership rights as the real thing. Simple concept, but with incredibly powerful implications. So how does a chunk of a building or a bar of gold actually turn into a token you can hold in the digital wallet? It sounds complicated, but let's walk through the mechanics step by step.
The whole thing really boils down to four key stages. First, someone has to acquire the asset. An issuer takes legal custody of it. You can't tokenize a building you don't actually own, right? Second, they mint it. They create the digital tokens on a blockchain, where each token represents a little piece of that asset. Third, and this is the crucial part, they link the data. The token's value is legally and digitally tied to the real asset's value. Finally, they manage the supply. If you decide to cash in your token for a piece of the real asset, your token gets burned, basically destroyed, to make sure that one-to-one backing always stays perfect.
Okay, so that's the how, but it all comes down to the why. Why even go through all this trouble? What's the point of turning a physical thing into a digital token in the first place? The difference here is just night and day. Traditional assets are usually rigid and illiquid, meaning they're a pain to sell quickly, and access is often limited to big-shot investors. Tokenized assets completely flip that around. They bring flexibility because you can own a fraction, a tiny piece of something really valuable, and they're globally tradable 24/7.
And the result is this just flood of new possibilities. Managing assets gets way cheaper and more efficient. You can trade directly with another person, peer-to-peer, cutting out all the expensive middlemen. And maybe the most exciting part, you can plug these real-world assets directly into the super innovative world of decentralized finance, or DeFi.
And this is where the two worlds really collide. All of a sudden, you can take a token that represents something like a US Treasury bill, one of the most stable assets on the planet, and use it as collateral to get a loan on a DeFi platform. You can actually earn yield on your little piece of real estate in what's called a liquidity pool. This is how stable, real-world value gets injected directly into the digital economy.
But with all this potential, it is so important to be realistic. This is still a very new technology, and that means it comes with both incredible advantages and some pretty significant challenges. So let's do a quick reality check and look at the pros and cons.
The pros are really powerful. Management is cheaper, everything is highly transparent thanks to the public blockchain, and assets that were once stuck can now be traded freely. The cons, though, are serious. You've got the wild volatility of the crypto market itself, a steep learning curve for new users, and probably the single most important challenge, trust. You have to be absolutely certain the company that issued the token genuinely holds and protects the asset. If they don't, that token is completely worthless.
So, this brings us to the bigger picture. What are the key risks that need to be solved? And what could the future look like if we actually get this right? The risks really fall into a few main buckets. You've got physical world risks, like the asset being mismanaged or even stolen from the vault. There are technology risks, like bugs in the blockchain's code or bad data feeds. And then, hovering over all of it is the biggest unknown of all, regulation. The rules for this new financial superhighway are still being written, and that creates massive uncertainty.
So, to sum it all up, what we're really watching here is the construction of a financial bridge. On one side, you have the trillions of dollars locked up in traditional, real-world assets. On the other, you have the speed, the efficiency, and the innovation of blockchain. It's an incredibly powerful combination.
And that leaves us with the final and most critical question. This technology could totally reshape finance as we know it. But will regulation act as the guardrails on this new financial bridge, making sure it's safe and helps it grow? Or will it become a giant wall, blocking progress entirely? That is the multi-trillion-dollar question that's going to define the future of, well, everything. Thanks for joining us on The Explainer.